What if the single most expensive decision of your financial life cost you nothing upfront? Buried in the fine print of millions of investment funds sits a number so small it reads like a rounding error. 1% annual fee. It sounds like nothing. It is not nothing. Start with $50,000. Put it in a fund charging a 1% annual fee. Now put the same $50,000 in an index fund charging 0.03%. Same market, same 7% annual return. 30 years later, the gap between those two portfolios exceeds $100,000. The mechanism is called an expense ratio, the annual percentage a fund charges to manage your money. It's deducted automatically, invisibly, before you ever see your returns. Most investors never notice it. To understand why 1% is devastating, you need to understand compound interest. Your money earns returns on both the original principal and every dollar of accumulated growth stacked on top of it. The base keeps growing. So does the damage done to it. Here's what that looks like. Investing $200 per month at a 7% annual return for 30 years grows to approximately $243,994, not $3,108.93. Most of that figure isn't your contributions. It's compounded growth stacked on compounded growth, decade after decade. Now introduce a 1% annual fee. Every year before compounding does its work, a slice of your portfolio disappears. That missing slice doesn't just vanish, it stops compounding forever. The loss multiplies across every subsequent year. Think of it as fee drag compounding in reverse. Every dollar paid in fees is a dollar that never compounds again. The damage isn't linear, it accelerates. Over 30 years, fee drag on a 1% fund consumes roughly 28% of the final portfolio value. In year 1, the gap between a 1% fee fund and a 0.03% index fund is almost imperceptible. By year 15, it becomes uncomfortable. By year 30, on that original $50,000, the difference results in approximately $1,485 in lost compounded returns. In Aurovale, citizens who never learned this rule tend to end up in the borrow badlands. The mechanism is specific. High fee funds shrink the compounding base every single year. So, by retirement, the extracted fees have silently outgrown many investors' total contributions. Here's the misconception that costs people the most: the belief that a 1% fund fee is negligible. It's one of the most expensive financial myths in circulation. On a long horizon portfolio, 1% isn't a rounding error. A second myth deserves equal force: that financial literacy tools are only useful once you've already built wealth. They're not. Understanding a single number, the expense ratio, is available to every investor, regardless of portfolio size. Financial literacy, the genuine understanding of money, investing, and markets, is the decoding key that separates those who build wealth from those who fund someone else's. The map exists. Most people are never handed it. Financial education matters precisely because the system profits from ignorance. Every dollar in fees flows somewhere. High-fee funds aren't accidents of poor design. They're products engineered to be chosen by people who don't know the alternative exists. The expense ratio lives inside a document called the fund prospectus. It's a single line. It's almost never the first thing a fund advertises, but it's the first number a financially literate investor checks before committing a single dollar. But here's the question most people never ask. If low-cost index funds have existed for decades and the math is this clear, why do high-fee funds still manage trillions in assets? The answer reveals something uncomfortable about how financial products are sold. High-fee funds often pay higher commissions to the brokers and advisors who recommend them. The incentive structure is inverted. The product that costs the investor the most frequently generates the most revenue for the person recommending it. This is why the fiduciary standard matters. A fiduciary is legally obligated to act in the client's best interest, not their own. Not every financial advisor operates under this standard. Asking whether your advisor is a fiduciary isn't paranoia, it's due diligence. Return to that $50,000 portfolio. For most working adults, That represents a decade of disciplined saving. The choice between a 1% fee fund and a 0.03% index fund isn't abstract. It's the difference between retiring with $100,000 more or less. Compound interest works because each year's gains become the new base for next year's growth. A portfolio earning 7% annually doubles roughly every 10 years. Fee drag disrupts this by shrinking the base every year before the compounding calculation begins. Here's the counterintuitive twist. According to the S&P SPIVA scorecard, over 20 years, roughly 90% of active large-cap funds underperformed their benchmark index. You're paying more for performance that statistically fails to materialize. The fee is the loss. Zoom out, and the picture sharpens. A 2023 Morningstar study estimated that U.S. investors saved roughly $170 billion annually in fund fees. That sum flows continuously upward, from individual investors toward institutional asset managers, through a mechanism that is legal, systematic, and largely invisible. Using debt strategically to acquire income-generating assets is a legitimate path to building wealth, but only when the asset generates returns that exceed its costs. A high-fee fund fails this test before the market moves a single point. The good news is structural. Expense ratios are publicly disclosed. Every fund registered in the United States is required to publish its expense ratio in its prospectus and on financial data platforms. The information isn't hidden, it's simply overlooked. Finding an expense ratio takes under 30 seconds. Search the fund's name on any major financial data platform, look for the field labeled expense ratio or annual fund operating expenses. A number above 0.5% warrants serious scrutiny. Above 1% demands an alternative. But the stakes extend beyond any single portfolio. Across an entire generation of retirement savers, the aggregate drain from high-fee funds represents compounded returns that never reach the people who earned the underlying income, redirected instead into institutional revenue. Here's the core insight. You can't control market returns. You can't control inflation. You can't control economic cycles. But you can control the expense ratio of every fund you hold. It's the one lever entirely within your reach. That's what financial literacy actually means in practice, knowing which lever moves. When investors collectively act on this knowledge, markets respond. ICI data shows average equity fund expense ratios fell from 1.04% in 1996 to 0.44% in 2022, as demand for low-cost index funds grew. Individual financial literacy produces measurable systemic effects. The habit extends beyond mutual funds. Annuities, managed accounts, and employer-sponsored retirement plans all carry fee structures that compound against you over time. The expense ratio check isn't a one-time action. It's a permanent filter applied to every financial product you consider. Remember the opening question. What if the most expensive financial decision of your life cost you nothing upfront? Now you know the answer. It costs you nothing today. It costs you $100,000 in 30 years. The fee is deferred. The damage is not. Ledger's rule is simple. Before buying any fund, find the expense ratio. One number, 30 seconds. The fee you overlook today is the compounding you lose forever. The path to compound heights has always been open. Checking the expense ratio before buying any fund is the one habit that protects your future self. Because the fee you overlook today is the compounding you lose forever.